My toxic trait is that every time I watch HGTV, I send my sister a picture of professionals knocking down a wall or putting in a half bath with a note that says, "Psh, totally doable. Psh, I could do that myself." Luckily, of the two of us, my little sister is always the voice of DIY reason, and she gently suggests that I leave projects like that to the pros. If you're considering a home renovation, whether you're going to DIY some of it or not, there are a lot of things to consider. Today, let's talk all things home reno, how upgrades can impact your value, updates to maybe think twice on, and we'll chat financing options with my fellow nerd and lending writer extraordinaire, Ronita Choudhuri-Wade. Hey y'all, welcome back to NerdWallet. I'm Nikita. If you recently closed on a fixer-upper, inherited a family property, or you're just looking to refresh a house you've owned for years, a home reno could be the way to go. This can help you build equity or get the best offer when you're ready to sell. Keeping up with necessary repairs and making smart improvements to the property are both proven ways to increase your home's value over time. But keep in mind, not all improvements are created equal, and not every renovation that you make to your home will be recouped with a higher selling price later. It's important to be smart and strategic with your renovations. Aside from keeping up with standard repairs, improvements like increasing curb appeal, improving efficiency with energy conversion features, increasing square footage, and making the home smarter can all improve the value of your home. Changes that are too specific to your own preferences, like a designer chef's kitchen, DIY paint jobs, or decreasing the number of bedrooms to expand another space, could potentially decrease the home's value. Keep in mind that the changes that you make to the house ideally would be recovered later, either in an equity increase or a higher selling price that covers some of the expense. While updates rarely recoup 100% of their costs, smart, efficient improvements can help you sell your home faster. Investing in an expensive pool or ultra high-end kitchen may prove great for you right now, but they can be difficult expenses to recoup later. Also keep in mind that you don't want to renovate so extensively that the home is above the average for neighboring houses. Remember that home prices typically reflect local homebuyer tastes and the amount they're willing to pay. But if this is your forever home and it's a feature that you really want and will enjoy, go for it. Resale shouldn't be your primary consideration if you aren't looking to sell in the near future. Okay, so we understand how renovations can help, what changes can get the most value, and some things to keep in mind before investing in upgrades. Now let's talk about the actual investment component. Let's be honest, a home renovation investment is not an insignificant financial amount. Renovations and remodels average $48,387. Fortunately, there are a few options to get this financed. Let's chat with Ronita to go over those options. So Ronita, we're talking home renovations. Are there any loans specifically for a home reno?
There are, and they go by a few different names. One is a home improvement loan, a home renovation loan, or a remodel loan. And a loan is just one option amongst a few that you can use for a home improvement project. So you can use a credit card for a home improvement project if it's below a certain amount. You can use a home improvement loan, which is a personal loan without collateral. And you can also look at options with collateral. So there is a cash out refinance, which is a second mortgage against your home for some of those large projects. And you can also look at home equity loans or lines of credit, which use the equity in your home to let you borrow money.
Okay, awesome. So how does a HELOC, a home equity line of credit, differ? How is that different from a home equity loan?
So home equity line of credit is different from a home equity loan, primarily because you have a longer draw period as well as a repayment period. So as the name suggests, a home equity line of credit means that you're using a line of credit against the equity value in your home. And so you can draw as much or as little as you need, and you only pay back the amount that you've borrowed. Now that's different from a home equity loan, where you are getting a lump sum up front and you have to start repaying that immediately. The other way that they differ is that a home equity line of credit has a variable interest, while a home equity loan does have a fixed interest rate.
You mentioned earlier, I kind of want to pop back. You mentioned credit cards being an option for paying for a home reno. At what point would you recommend just charging it to a credit card or versus getting a loan?
Sure. So with credit cards, you tend to have an APR or interest rate and fees that are higher than a loan. So if you're looking at smaller projects, whether it's like a small paint job or new furniture or anything that's below a few $1,000s, a credit card's not a bad option. But of course, we always say if you have the cash, it's better to pay with that.
Right.
But if you're looking at a loan, a loan has a longer repayment period. You can borrow up to $50,000 or $100,000 or even $10,000. And so that usually has a lower interest rate. And if you use something like your home equity with an equity line of credit or a home equity loan, your interest rates will tend to be even less.
Is there a clear option that you would recommend at a certain dollar amount? Like say if repairs are under $25K, this might be your best bet. If they're over this number, this might be your best bet. Is there like a dollar amount that would lean you one way versus the other?
It really depends. And it depends on the interest rate environment as well as what your plans are for the house in the short and the long term. So again, if you're doing small renovations, a few things here and there, you can look at a credit card and pay it off, of course, as soon as you can. If you're looking for something a little bit larger, personal loans, they can start at $2,000 or $5,000 and go up to about $25,000, and you tend to have rates that are lower than credit cards. But if you're looking for that mega size, huge renovation, you might want to consider options like a cash out refinance where you are getting a second mortgage, but you can take the cash out for the project you're working on. But again, the interest rate environment really matters here, as well as the equity that you have in your home. If you do have equity, I would suggest looking at home equity lines of credit or a home equity loan for those, $10,000, $15,000, $20,000, $50,000 projects. But if you don't have equity in your home, you can consider non-collateral solutions like a home improvement loan or a credit card.
Are there any key terms that you can think of that homeowners should keep an eye out for when they're applying for these different home improvement loans?
Sure. So right off the bat, your APR is going to be very important because an APR or annual percentage rate means the interest as well as the fees on your loan or your line of credit. So what you want to do is compare APRs between different lenders, and that'll give you a real apples to apples comparison. The next term to know is LTV or loan to value. So what we're looking at there is the value of your home compared to how much you owe on it. So whether the mortgage and things like that. And this is a big qualifier for lenders, especially when they're looking at equity in your home and you're looking at loan products. Loan term, of course, is really important. How long are you going to be repaying? And make sure that your payments work with your budget. And that takes us to loan payments, right? So do you have a monthly payment you can easily make, comfortably make? And what does your budget look like over the next few years? Lastly, especially with the home equity line of credit, you do want to know the draw period as well as the repayment period. So the draw period is the time where you can draw funds from the line of credit. And this can be up to 10 years or so. While the repayment period is when you need to start repaying principal and interest. So during the draw period, you can draw the money and pay and make interest-only payments, while the repayment period, you have to make interest and principal payments.
Awesome. Thank you so much, Ronita.
Thank you.
Before we wrap up, I also want you to think about the time commitment for a renovation. You'll likely need to get permits from the city before you can even begin the work, which can take months. And then once you settle on a contractor and actually start the process, it can be another several months before they're able to get you to the top of their job queue. Many tradespeople line out their jobs a year or more in advance. All of this to say, a degree of patience will likely be necessary for any significant home improvement project. Buying a house that needs work can be a great way to help you nab your ideal location. And buying to flip is huge in the real estate world. Just remember what we talked about before and make sure that the timeline and cost of renovations work for you. I'll see you next time.